Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Clinuvel Pharmaceuticals Limited, ASX code CUV. G'day, Elio.
Yeah, g'day, Phil. It's great to be back, and obviously talking about complex businesses like this and making it simple to understand is something I try to do, but it doesn't erode the risks. But of course, Phil, we're going to get to that later on in this presentation.
Okay, so they produce their main product is a drug to treat a rare skin disease that causes extreme light sensitivity. Tell us about that.
Yeah, it's a ripper, isn't it? I mean, it's a little bit of a tongue twister, but obviously its history sort of led it down this path where a group of Australian researchers picked up the drug technology and ultimately went about developing drugs that, can help with the intolerance of, photosensitivity, as it were, both natural light and in some cases even artificial light. So this can obviously lead to liver disease and gallbladder dysfunction, basically a bunch of nasty things. So I'm not going to go into the medical science here, but they came up with a peptide, afamelanotide, which is being sold to the market as SCENESSE, which is the product you just described. And basically that product is being sold all around the world and is actually funding its business, in particular its R&D journey. Again, another topic we're going to get to in this recording. But it's quite exciting, provided they can get it right, of course.
A few years ago, they attracted a raft of major investors, from superannuation funds to asset management giant Fidelity and even the founder of Napster. Is the register still as heavyweight?
It's a good one, isn't it? Well noted. It's it does have its big backers who do believe in the business and have ridden this stock, much like the roller coaster that its share price implies. So you mentioned that Napster founder, like Sean Parker, for example, and yes, his fund, Ender One LLC, they still own over 5% of the business, but it's now the second biggest shareholder behind ex-CEO Phil Walgren. To be frank, at certain camera angles, he can be confused with Ray Romano, to be honest, and controversy has followed him during his tenure at the company. But big backers have seen through that and they've backed him and the company. And I think he's being well deserved in what he's received. And I'll explain a little later why.
So in their latest annual report, the chair described the transformation of the business into a diverse pharmaceutical with multiple products. So they're obviously not going to be resting their laurels just on a single product. Is this unusual in pharma companies?
Oh, look, it's a great question, Phil, because to be honest, this really lies the opportunity. Unlike many other pharmaceutical businesses where they may have various derivatives of their drug that they use to treat other various ailments and they go through the FDA process and the like, or the TGA or equivalents in Europe, this one here is really an opportunity to basically sell its service as an over-the-counter product, or what it calls photocosmetics. The good news is that it's currently already been identified as safe. So it's effectively taking it out of the lab and putting it into the hands of the mum and dad. And Mr. Walgren, who I touched on earlier, he admitted himself that really it's like the company doing closing the circle, as it were, because Epitan, which is what the company first listed as in 2005, some 2 decades ago now, was actually designed as a drug solution for delivering fake tans. So the addressable market is quite huge in regards to this over-the-counter space. It's going to take work and, dare I say it, it's going to take a lot of money. So they've got to now convince consumers that this is a healthier solution than sitting in a space tub getting pumped with UV, which is now illegal, I think, these days in Australia, or even getting spray painted like a car at a panel shop. They've got a first pilot program in Europe. If they can prove that there's success there, obviously there's a big market in the US and no doubt we'll feel the benefit here in Australia. But obviously, given SCENESSE is so widely accepted nowadays, even though it addresses a small market, we'll get to that in a moment, if it can get into cosmetic products, then that'll be a big boon for the company. And as Mr. Walgren said, does close the loop.
The annual report also mentioned their direct distribution model. Is that unusual?
As the name suggests, it's basically putting their big boy pants on and tackling the market directly, rather than necessarily going through a third-party distribution network. Now, this can be a risk. It's an obvious risk, and we'll talk a bit about that later. But for an established business like Clinuvel Pharmaceuticals, probably not. To me, this actually makes sense. I mean, they're well established, their product is safe, and there's obvious benefits on the back of it. So, notwithstanding the travails of running a direct distribution model, I think for CUV it works.
Give us a little bit of an insight into their history, Elio.
Yeah, so as mentioned, in 2005, they were Epitan, but then the FDA basically sent the business to its knees until it was renamed a year later, Clinuvel Pharmaceuticals. And basically, an Australian team licensed the molecule, and their desire was to maximise the medicinal benefits of the drug rather than the cosmetic ones, which we just spoke about earlier. So this led the researchers down a path of curing a pretty rare skin intolerance condition that causes, painful photosensitivity. That SCENESSE product, as I mentioned, it's rare. The condition that it services is pretty rare. In fact, if you go to the company's website, they say that they've only administered some 14,500 doses of that over the past 17 years globally. So I think it's 1,400 individuals globally have actually received SCENESSE, and the drug can cost anywhere between $90,000 to $140,000 to administer, though, of course, governments subsidise that treatment quite heavily for those that suffer that terrible affliction. So this sale of SCENESSE has supported the R&D work the company has got, which is, to be frank, quite significant, and we'll talk about that in a moment. And despite the small cohort that it does sell to now, the earnings performance for the company has actually really reflected the difference it's made to its patients. It's actually quite good. As I alluded to in the introduction, the price has been wild for some time, falling 60% from its peak, if you can believe that, back in September 2021. So I think now's a good time to ask us as investors, is, Clinuvel ready to step back into the light once more?
Yeah, it's interesting to look at the financials, which we're going to talk about now, and what the return has been. It's been quite good, and the revenue increases have been great as well. Tell us about the financials and what they look like from your point of view.
Yeah, to be fair, it's all about perspective, Phil, because, of course, if you bought at the peak, you probably disagree with your view. But look, overall, the company scores a 74. So it's not in the elite class of market performances, or performers, I should say, far from it. We're going to break that score of 74 down a little bit, though, and I'll start with quality, which is really, pardon the pun, the shining light in regards to CUV's result, because it is highly profitable.
You've got 97 as the score, haven't you, for the quality?
Yes, that's correct. Yes, 97 is the quality score because, profit margins are above 50% for the last few years. And if you sort of, knock out the COVID impact, the company's been managing to grow its operating and net profits basically every year since it first became profitable in 2017. So, in fact, actually, profits are now 4 times greater than what they were back then. So, further supporting the idea that COVID was a blip, revenues in 2020 actually rose that financial year, which does show a certain element of resilience in the company's earnings. So that score of 97, as you said, is a combination of the fact that its return on capital employed and return on equity are both above 20%. It's got low bankruptcy risk, and the Piotrowski score is actually 6. So earnings manipulation is also low, and you can further see evidence of that in the very strong cash balance and regular strong free cash flow that the company actually generates. But of course, as with all of these types of businesses, the big bugbear is value. And like many profitable biotech stories, the stock rates poorly from a value perspective. It really doesn't rate much at all. If my memory serves me correct, I think it's around 22, Phil. So, and that's despite the significant pullback in price from its all-time high in 2021. So this is an obvious risk because, we have to consider that. But then again, Clinuvel are a profitable business and they're growing their profits, and they're one of the few profitable businesses in this space. The company has a saleable product in the US and Europe. It's also got a strong pipeline of coming work. It deserves the premium, to be fair, but obviously a lot of that premium will depend on what happens moving forward. So let's say there was a consolidation when the stock was, say, 43. Back then, when there's a consolidation, the stock was like $43. The value score was 4. It was pretty poor. Prior to the company's latest annual result, it was actually 15. Notwithstanding the weak value rank, it's actually been improving. But the oxymoron is, of course, the price has been falling. And there are risks, and I'll talk about them in a moment. I'm going to weave in a company that I spoke about recently as well into those. But it is cheaper than CSL, Neuron, and dare I say it, Nanosonics. But you're not going to find Benjamin Graham buying this stock anytime soon. Momentum, that is interesting because I think the pullback does create a bit of an opportunity in price. I mean, if you look at the stock, its rank comes through as 79. Before it reported, it was actually 73. It's come down recently in the last few weeks, but still I think it's quite solid. It started the new financial year actually at 56. There's been consistent improvement here, which I like. There's been improvements to the 2024 and 25 earnings expectations, which is another plus. Look, that high of 2021, look, it stands out like a beacon. Listeners will also note that the price has retraced all the way down back to that $13.45, $14.15 support range, which is a key level that I'm watching at the moment. It was first seen back in 2018. It continues today. It's actually been tested 3 times since that point, back in March 2000, in June 22, and then September 23. So it's a significant level, and we need to watch that. So from my view, the upside target and a good position to take profits would be around the $28 mark if it goes in that correct direction. Either way, though, you'll be maintaining a position at this point. We hope it certainly gets to 28 because if it falls through support, watch out below, and that's something we've got to watch.
Are you picking shares on gut instinct, buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. Just as a little aside here, last week Chris and I discussed another company. It was our Super Auto Group. And we also covered a little bit about enterprise value and about how if the enterprise value is less than the market value, it means the company has cash on hand. And so when I looked at Clinuvel on Stockopedia and being able to see that the EV was less than the market value, I was able to say, okay, they've got cash on hand. So, yeah, great lesson to learn.
Very important, particularly
a very good shortcut, yeah.
Correct, particularly when you've got big aspirations in regards to growth and where you want to expand your business, because everyone's got to pay the ferryman and cash is the cheapest form of financing. And if you got that on hand, it's a great privilege to have.
Yeah, especially in these days of high interest rates. So what's the outlook?
Yeah, look, when it comes to any pharmaceutical business, looking at the company's outlook to understand where its pipeline for future growth catalysts is pretty important. It is important, though, that carries risks. Investors need patience, basically, to realise the goals that the company has. But on the surface, at least, in regards to CUV, the pipeline looks full. They're looking to use their SCENESSE technology in adolescents. Currently can only be used in adults. So that'll be another potential win, but again, another small part of the market. Now, they do have currently out there at the moment a treatment for vitiligo. Unfortunately, it's known as Michael Jackson syndrome. Perhaps that might make a little more clearer to people, which is basically when pigments effectively lose their colour, which can obviously be disastrous. There's other conditions they're treating for, like skin blistering. There's more light-sensitive solutions that they're looking to develop, and now even stroke. And I note with great interest, the recent chairman-elect to the company is Mr. Jeffrey Rosenfeld. Now, he's a great neurosurgeon from the Alfred Hospital here in Victoria. I think it's the Alfred. Oh, it's either the Alfred or the Austin. And basically, he deals with, predominantly with nasty brain stuff every single day for a living. You'll find him on Google everywhere, of course. And the fact that he continues to remain at the company, which he first joined as a non-executive director back in 2020, that's obviously a positive. And now he's been elevated to the position of chair. So that's another win, hopefully, for the company.
Okay, as always, let's talk about the risks and about another stock this week that demonstrates the problems with companies in this sector.
Exactly. Look, I don't need to tell experienced investors, Phil, of the obvious risks involved with pharmaceutical businesses, especially those that have trials currently in the field. And there is that recent example that we're going to touch on in a moment. So even though it would appear that basically the bets are locked, right? You can almost pick that they're going to be in a winner. It only can come undone with just one cohort of poor results. It's quite extreme how it can happen. So notwithstanding that SCENESSE has been out in the field for some time and that the early signs from its vital IGO tests actually look quite exceptional, there is a risk. There's always a risk that it doesn't work. So investors best remember that when considering CUV, because of course, this is not too dissimilar from a stock that I covered quite a few months back now, and that was Nanosonics. Now, they had basically the same. Its runway looked clear, but I spoke of a big risk to the delay of the Chorus product, its endoscope sterilization product. And guess what? Fast forward to today, and there's another delay in Chorus. And now that is expected to be delivered in the first quarter of 2026. Plus, there was a profit downgrade that came as a result. So, as you would expect, the price fell quite heavily on that news. And it's an important reminder because it shows us that big shifts in the price can happen to both non-profitable and profitable biotech businesses. So, no one is immune, pardon the pun. So, back to CUV. The risk is that, of course, this pilot that they've got for their cosmetic products fails in Europe. That's something they need to consider. There's other standard pharmaceutical risks like, regulatory, financial, valuation, intellectual property, all that sort of thing. I mean, just on that bit, there's competing technology risk all the time. Like, for example, there's a potential rival coming from Mitsubishi in Japan to the SCENESSE product, even though it's a relatively small target market, even though there's challenges with regards to its early studies and what they've been able to show. It still has impacted the price quite significantly. There's also continued distribution risk that we talked on earlier, given they're doing it themselves. And Dr. Walgren is also a key person risk because he joined the business in 2005 when it was on its knees. He navigated it through various regulatory setbacks and ultimately to first approvals and commercial revenues. Well, now he is now not driving the bus anymore. And he is their largest shareholder. So that is a risk that we do need to consider as well. Notwithstanding some, I suppose, aggrieved shareholders will be happy to see him go, given his rather generous payback. But for one, acknowledge the fact of what he's been able to do with what has been an incredibly challenging situation, getting him to this point.
So, Elio, I've just got to say I'm in awe of the amount of detail you guys understand and analyse in all of these companies. I mean, across the whole of the ASX. So I value your final thoughts on this company.
Yeah, you're right, Phil. There's a lot to unpack with CUV. So there's obvious opportunities that we talked about, but then there are some big risks that the investors need to be cognizant of. So they're profitable and they're not as expensive as, others that are in the similar space. And this is despite that and with that price decline. So they're sitting at a nice price level at the moment, in my view. But those risks are real. And just because it makes money now doesn't immunize it against future potential challenges. Investors need to know this. So whilst it might be premature to suggest the company can get back to all-time highs back in 2021, its runway has enough activity that suggests it could run, should a positive tailwind come, of course.
And well, as we've discussed before in this sector, which covers biotech, pharmaceuticals and hardware devices, you can also draw a parallel with ResMed, I'm assuming, and their performance over the last year or so.
Yeah, its inability at the time to capitalise on the pain of a major competitor was a worry for shareholders. It saw its share price fall, I think, some 40% from peak to trough. But, sensibility has returned, stability in the price has remained, and notwithstanding that you do have to pay to play for a company like ResMed, its underlying qualities have come to shine to light. So it's overcome that initial disappointment. It's probably at a more fairer price, even though you're still playing nosebleed levels. And I think, ResMed is a nice opportunity now. Well, look, at least it's a hell of a lot better buying it now than it was over $40.
Okay, Elio D'Amato, thank you very much for joining me again.
Thanks very much, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.